When the market turns against you, leadership is no longer a title or a position on an org chart. It becomes a test of character, clarity, and courage. Good times hide weak leaders. Easy money, rising demand, and forgiving customers allow average decision makers to look competent. When conditions tighten, costs rise, customers hesitate, and competitors panic, the truth comes out fast. Down markets don't create weak leadership, they expose it. In difficult markets, uncertainty multiplies. Revenue forecasts become unreliable. Investors get nervous. Teams look for reassurance, and everyone wants answers that don't exist yet. A weak leader reacts emotionally to this pressure. They hesitate, second-guess themselves, and wait for more information that never fully arrives. They delay decisions because they are afraid of being wrong. That fear spreads through the organization. Employees feel it, partners sense it, customers notice it. Momentum dies not because the market is bad, but because leadership froze. Strong leaders understand that clarity matters more than certainty. They accept that imperfect information is the norm in tough markets. Instead of asking, what if this goes wrong? They ask, what happens if we do nothing? They know indecision is often more expensive than making a wrong call. When markets turn hostile, speed becomes a survival skill. Leaders who can decide quickly, adjust fast, and move forward decisively keep their companies alive while others stall. Weak leadership often shows up as denial. Some leaders pretend nothing has changed. They cling to old strategies, outdated pricing, bloated teams, and unrealistic projections. They hope the market will go back to normal instead of adapting to the new reality. This kind of thinking is deadly. Markets don't care about your plans, your history, or your comfort. They reward adaptation and punish stubbornness. Strong leaders confront reality early, even when it's uncomfortable. They cut losses fast, restructure when needed, and make hard calls before the situation becomes desperate. Another way weak leadership is exposed is through communication. In bad markets, silence is poison. Leaders who avoid their teams, sugarcoat problems, or hide behind vague optimism lose trust quickly. People don't need false positivity. They need honesty and direction. Strong leaders communicate clearly and directly. They acknowledge the challenge without dramatizing it. They explain what's changing, why it's changing, and what actions are being taken. This transparency builds confidence even in uncertainty because people know someone is actually in control. Down markets also reveal whether a leader has been building real capability or just riding favorable conditions. When revenue slows, weak leaders suddenly realize they don't know their numbers, their margins, or their cash flow in detail. They've been delegating critical thinking instead of mastering the fundamentals. Strong leaders, on the other hand, know their business cold. They understand where money is made, where it's lost, and what levers can be pulled quickly. That knowledge allows them to act decisively when pressure hits. Fear is another divider. Weak leaders are driven by fear of failure, fear of criticism, fear of looking incompetent. That fear leads to conservative, defensive behavior at exactly the wrong time. They protect their ego instead of the business. Strong leaders feel fear too, but they don't let it drive their actions. They focus on what must be done, not how they will be judged. They understand that leadership is not about being liked or praised, but about making decisions that keep the company alive and competitive. Down markets are also when leadership discipline is tested. Weak leaders abandon standards. They tolerate poor performance because they're afraid to push people when times are hard. They avoid holding others accountable because it feels uncomfortable. Strong leaders do the opposite. Raise standards. They demand focus, efficiency, and execution. They know that discipline creates stability when everything else feels unstable. High standards don't disappear in tough times. They become more important. Finally, adversity reveals whether a leader sees pressure as a threat or a filter. Weak leaders see bad markets as something happening to them. Strong leaders see them as a sorting mechanism. Weak businesses, weak strategies, and weak leadership get eliminated. Strong ones get leaner, sharper, and more resilient. Leaders who understand this don't panic. They recognize that downturns create opportunity, but only for those prepared to act while others retreat. When the market turns against you, excuses stop working. Titles stop protecting you. Past success stops mattering. All that's left is your ability to think clearly under pressure, decide quickly with incomplete information, communicate honestly, and act decisively. That's when leadership is no longer theoretical. It's visible. And the market, without mercy or emotion, exposes exactly who is strong enough to lead and who is only pretending when conditions were easy. When the market turns against you, the biggest danger is not the competition, inflation, regulation, or even falling demand. The real danger is hesitation. Slow decisions quietly kill businesses long before balance sheets show the damage. In tough markets, time becomes the most expensive resource you have, and leaders who don't understand this pay for it with relevance, cash flow, and eventually survival. In good times, slow decision-making is often invisible. Revenue is flowing, customers are forgiving, and mistakes can be corrected without serious consequences. Leaders get comfortable, meetings multiply, approvals stack up. Everyone wants more data, more projections, more validation. This habit feels responsible when conditions are favorable, but it becomes lethal when the market tightens by the time a slow organization finally decides the opportunity has passed or the threat has already done its damage. Markets don't wait for confidence, they punish hesitation. When demand drops or costs rise, businesses must adjust pricing, restructure operations, renegotiate contracts, or reposition offerings quickly. Leaders who delay these moves out of fear or overanalysis bleed slowly. Cash reserves shrink, morale drops. Competitors who act faster take market share. The irony is that many leaders delay decisions to avoid risk, yet that delay often creates the biggest risk of all. Speed in decision-making doesn't mean recklessness. It means understanding that perfect information is a luxury you no longer have. In hostile markets, leaders must make high-stakes choices with incomplete data. Weak leaders get stuck here. They tell themselves they're being cautious, but in reality, they're avoiding responsibility. Strong leaders accept uncertainty as part of the job. They make the best decision possible with what they know, then adjust as new information arrives. One of the reasons decisions slow down is ego. Leaders don't want to admit that a strategy isn't working. They don't want to reverse past decisions because it feels like failure. They hesitate because changing course publicly exposes mistakes. In tough markets, this mindset is fatal. The market doesn't care about your pride. It rewards leaders who can detach their ego from their decisions and do what's necessary, not what feels comfortable. Another cause of slow decisions is excessive consensus. When pressure rises, some leaders try to spread responsibility by involving more people in every choice. While collaboration has value, over-collaboration creates paralysis. Everyone has a different opinion, risk tolerance, and agenda. In fast-changing markets, leaders must listen, but they must also decide. Leadership is not democracy during a crisis. It's accountability. When everyone is responsible, no one truly is. Slow decisions also send a dangerous signal internally. Teams interpret hesitation as uncertainty or weakness. Employees begin to worry about job security, direction, and leadership competence. High performers start looking for exits. Average performers disengage. Momentum fades. All of this happens quietly before layoffs, closures, or public failures ever occur. Strong leaders understand that decisiveness itself is stabilizing. Even difficult decisions create confidence when people see that someone is steering the ship. Financial damage compounds quickly when decisions slow down. Delayed cost-cutting means burning cash unnecessarily. Delayed investment decisions mean missing strategic openings. Delayed exits from failing projects drain resources that could be redirected. In downturns, small delays turn into large losses because margins are thinner and tolerance for error is lower. Leaders who move fast preserve optionality. Leaders who wait lose it. There is also a psychological cost to indecision. Leaders who delay decisions stay in a constant state of stress. Every unresolved choice becomes mental clutter. Anxiety builds. Focus weakens. This emotional load spills into other areas, affecting communication, judgment, and energy. Strong leaders reduce this burden by deciding and moving forward. Even when outcomes are uncertain, action restores a sense of control. Fast decision-making in tough markets requires preparation. Leaders who know their numbers, understand the customers, and have clear priorities move faster because they don't need endless analysis. They've already done the thinking before the crisis arrived. Weak leaders are exposed because they relied on favorable conditions instead of building operational clarity. When pressure hits, they're scrambling to understand their own business. Markets reward leaders who act while others freeze. History repeatedly shows that companies born or reshaped during downturns often outperform those that played it safe. The difference isn't luck, it's leadership speed. When competitors hesitate, decisive leaders can negotiate better deals, hire stronger talent, secure better terms, and reposition their brand. These opportunities don't last long. They belong to those who move first. When the market turns against you, every delay has a cost, even if it doesn't show up immediately. Slow decisions feel safer, but they quietly drain strength. Speed, clarity, and decisive action don't guarantee success, but hesitation almost guarantees decline. In hard markets, leadership is measured not by how carefully you think, but by how quickly and courageously you act when it matters most. When the market turns against you, cash flow stops being just another metric on a dashboard and becomes the lifeline of the entire business. Profits can look good on paper, assets can appear impressive and long-term, forecasts can sound optimistic, but none of that matters if cash isn't moving fast enough to keep the business alive. In difficult markets, companies don't fail because they lack ideas or vision. They fail because they run out of cash while waiting for conditions to improve. Many leaders confuse profitability with liquidity. Business can be technically profitable and still collapse because cash is tied up in inventory, receivables, or long-term projects that no longer match market reality. When demand slows or payments are delayed, that gap between money earned and money received widens dangerously. Leaders who don't immediately shift their focus to cash flow often realize the problem too late when options are already limited. Strong leaders treat cash flow like oxygen during downturns. They track it daily, not monthly. They understand exactly where money is coming from, where it's going, and how quickly it's moving. This level of awareness allows faster, sharper decisions. Weak leaders avoid looking too closely because the numbers make them uncomfortable. That avoidance doesn't protect the business. It accelerates its decline. One of the first mistakes leaders make is protecting expenses that no longer serve survival. In good times, businesses accumulate costs that feel justified: extra staff, premium tools, oversized offices, experimental projects. When the market turns, these same costs become heavy anchors. Leaders who delay cutting them because of emotional attachment or fear of backlash burn cash unnecessarily. Cash doesn't care about intentions or loyalty. It only responds to discipline. Protecting cash flow doesn't mean panic-driven cuts across the board. It means intelligent prioritization. Leaders must distinguish between expenses that generate or protect revenue and expenses that only support comfort or image. Sales, core operations, and customer retention deserve protection. Vanity projects, inefficient processes, and underperforming initiatives do not. Every dollar saved extends the runway and buys time to adapt. Another critical element is speed in collecting money owed. In tough markets, customers delay payments, renegotiate terms, or quietly disappear. Leaders who hesitate to chase receivables out of politeness or fear of damaging relationships pay the price. Professional, firm follow-up is not aggressive, it's survival. Businesses that get paid faster gain flexibility. Those that don't become hostages to their own invoices. Inventory is another silent cash killer when markets shift. What once sold quickly can suddenly sit idle, locking up capital. Leaders who ignore this reality continue ordering, producing, or stocking based on outdated assumptions. Smart leaders reduce exposure, clear slow-moving stock, and accept short-term discomfort to regain liquidity. Holding onto inventory out of hope is not strategy. It's denial. There is also a mindset shift required around growth in hostile markets. Growth funded by cash burn is dangerous. Leaders must abandon the idea that expansion alone will solve problems. Scaling inefficiency only magnifies losses. Cash first thinking forces leaders to ask harder questions. Does this activity generate cash now? Does it protect existing cash flow? If not, why are we doing it? That decisions become sharper under cash pressure. Borrowing can be a tool or a trap. Leaders who understand their cash flow use debt strategically to bridge short gaps or seize clear opportunities. Leaders who borrow to delay hard decisions simply push failure further down the road. Cash discipline reveals whether debt is being used for strength or avoidance. There's a psychological challenge here as well. Focusing on cash flow strips away illusions. It forces leaders to confront reality without excuses. That honesty can be uncomfortable, especially for founders or executives used to growth narratives and long-term vision. But markets reward realism, not optimism. Leaders who face cash truth early have more choices than those who wait for reassurance. Teams also respond to cash-aware leadership. When employees see leaders acting decisively to protect the business, trust increases even during cuts or restructuring. Uncertainty grows when people sense that leadership is hoping rather than managing. Clear communication around cash priorities helps teams understand why certain decisions are being made and what truly matters right now. When the market turns against you, cash flow is not just a financial issue, it's a leadership test. It exposes who can separate emotion from execution and who cannot. Businesses that survive downturns are rarely the smartest or most innovative. They are the most disciplined with cash. Every decision either preserves oxygen or wastes it. Leaders who understand this early don't just survive tough markets, they position themselves to dominate when conditions improve. When the market turns against you, emotional control becomes one of the most powerful and underrated competitive advantages a leader can have. Volatility doesn't just attack balance sheets and revenue streams, it attacks the mind. Fear, frustration, ego, panic, and impatience rise fast when numbers turn red and certainty disappears. The leaders who survive and win are not the most optimistic or motivational, but the ones who can stay mentally steady while everyone else is reacting. Most bad business decisions in downturns are not caused by lack of information. They are caused by emotional reactions to pressure. Leaders panic and cut the wrong things, or they freeze and cut nothing at all. Some chase reckless opportunities to fix everything fast, while others cling to failing strategies because admitting reality hurts their ego. Emotional instability clouds judgment, shortens time horizons, and turns decision-making into self-defense instead of strategy. Emotional control does not mean suppressing fear or pretending everything is fine. It means recognizing emotions without allowing them to dictate actions. Fear is natural when markets shrink, customers disappear, or competitors collapse. The disciplined leader acknowledges the fear, then asks better questions. What is actually within my control right now? What decision improves our position regardless of how the market behaves tomorrow? This shift from emotional reaction to controlled response separates professionals from amateurs. Markets reward calm thinkers because chaos creates mispricing, inefficiency, and opportunity. When competitors panic, they dump assets cheaply, abandon customers, and make rushed decisions that weaken their position. Leaders with emotional control see what others miss. They negotiate better deals, hire stronger talent that suddenly becomes available, and restructure from a position of clarity rather than desperation. Emotional stability allows you to play offense while others are still trying to survive. Inside the organization, emotions spread quickly. A nervous leader creates a nervous company. Employees sense tone long before they hear words. If leadership is reactive, defensive, or erratic, teams lose confidence and performance drops. People stop taking initiative and start protecting themselves. Productivity declines not because people are incapable, but because uncertainty dominates the environment. Emotional control at the top stabilizes the entire system below it. Clear communication depends on emotional discipline. Leaders under stress often overpromise to calm people or stay vague to avoid uncomfortable conversations. Both approaches damage trust. Controlled leaders speak honestly, even when the message is difficult. They don't dramatize problems and they don't sugarcoat reality. This balance builds credibility. Teams may not like every decision, but they respect leaders who are steady and transparent under pressure. Emotional control also protects leaders from short-term thinking. In tough markets, it's tempting to sacrifice long-term positioning for immediate relief. Slashing essential capabilities, damaging key relationships, or abandoning brand trust might reduce pressure today but weaken the business tomorrow. Calm leaders resist the urge to react impulsively. They evaluate trade-offs carefully, understanding that survival and future strength must be balanced, not chosen blindly. Another hidden benefit of emotional control is negotiation power. Dealing with investors, lenders, suppliers, or buyers, emotional signals matter. Desperation weakens leverage. Confidence rooted in preparation and realism strengthens it. Leaders who remain composed communicate strength even in adversity. They negotiate terms rather than accept them. Emotional discipline allows them to pause, listen, and respond strategically instead of revealing urgency through behavior. Ego is one of the most dangerous emotions during downturns. Leaders who tie their identity too closely to being right struggle to adapt. Markets don't care about past success or personal pride. Emotional control includes the ability to admit mistakes, quickly change course, and let go of strategies that no longer work. Flexibility without emotional attachment keeps businesses alive when rigid confidence kills them. There's also a personal endurance element. Prolonged market pressure wears leaders down mentally and physically. Poor emotional regulation leads to burnout, tunnel vision, and poor health, all of which reduce decision quality. Leaders who manage stress deliberately think clear for longer. They create routines, distance themselves from constant noise, and protect their mental bandwidth. This is not softness, it is operational discipline applied to the mind. When markets turn hostile, everyone has access to similar data, forecasts, and advice. What separates outcomes is how leaders respond internally. Emotional control allows rational prioritization, consistent execution, and strategic patience. It turns volatility from a threat into an environment where discipline outperforms panic. In the end, markets don't just test businesses, they test the emotional strength of the people running them. When the market turns against you, weak businesses die quickly, while strong ones not only survive, but often emerge stronger. The harsh truth is that downturns are not fair. They do not reward intelligence, effort, or intentions. They reward structural strength, adaptability, and discipline. Markets expose weaknesses that were previously hidden by growth, rising demand, and favorable conditions. What looked solid when everything was easy suddenly cracks under pressure, revealing flaws in strategy, execution, and leadership. Weak businesses often fail because they were built for good times, not for resilience. They over-leveraged themselves, relied on continuous cash inflows, and tolerated inefficiencies that went unnoticed while revenue was flowing. Their systems, processes, and teams were optimized for expansion, not contraction. Conditions shift, their fragile foundation is exposed. Costs that were manageable in growth periods become burdens. Customers who were loyal in abundance become negotiators or vanish. Suppliers tighten terms and competitors act faster. In this environment, weaknesses compound often faster than leaders can react. Structural issues are the first to reveal themselves. Businesses with poor financial discipline, unclear operational systems, or weak leadership lack the flexibility to respond to adversity. Small inefficiencies ignored during growth become liabilities under pressure. Inventory mismanagement, delayed receivables, or ineffective sales processes suddenly weigh heavily on liquidity. Companies that could have survived minor shocks now struggle because their foundation wasn't designed for stress. Leadership quality is the second critical factor. Weak leadership often relies on optimism, ego, or hope rather than clear analysis and decisive action. When the market turns, these leaders hesitate, overanalyze, or cling to failing strategies. They delay cost-cutting, fail to restructure operations, and refuse to make tough personnel decisions. Fear of short-term criticism or failure leads them to inaction, even as external pressures intensify. The market punishes indecision relentlessly. Strong businesses, by contrast, are led by people who act decisively under pressure. They confront reality, cut losses, and pivot quickly without letting emotions dictate strategy. Adaptability distinguishes strong businesses. Those that survive downturns are not necessarily the largest or most innovative, but they are flexible. They can scale down operations without destroying their capability to scale up when the market recovers. They restructure processes, reprioritize resources, and shift strategies to align with current conditions. Weak businesses, in contrast, treat market changes as anomalies rather than signals, trying to maintain the status quo in a world that has already moved on. Rigidity becomes their undoing. Cash flow management is another area where strength shows itself. Businesses that fail often mismanage. Cash in good times, assuming future revenue will cover obligations. In adverse markets, these assumptions break down. Accounts receivable slow, margins compress, and financing options become scarce. Strong businesses, on the other hand, maintain liquidity buffers, monitor cash flow daily, and make proactive adjustments. They treat cash as survival oxygen, not a convenience, allowing them to weather storms that bankrupt others. Customer relationships also reveal strength. Weak businesses may have been transactional, relying on volume rather than loyalty. When the market tightens, customers become selective. Companies that have cultivated trust, value, and reliability retain their clients even under pressure. Those that haven't experienced rapid attrition. Strong businesses understand this and invest in service, communication, and problem solving during downturns. They use adversity as a chance to reinforce value and deepen relationships. Other difference is decision speed. Weak businesses often stumble under pressure because decision-making slows when stakes rise. Leaders debate endlessly, seek consensus, or wait for more data while competitors move first. Strong businesses embrace decisive action. They act with imperfect information, learn from outcomes, and adjust quickly. Momentum, even in small increments, keeps strong companies ahead while weaker ones remain paralyzed. The culture within the organization is equally revealing. Weak businesses often have low accountability, poor discipline, and reliance on short-term incentives. When markets turn, these cultural weaknesses manifest in low productivity, disengaged teams, and confusion about priorities. Strong businesses cultivate a culture of discipline, responsibility, and execution. Teams understand what is expected, are aligned with the company's priorities, and execute without waiting for step-by-step instruction. This internal strength enables resilience even under external pressure. Finally, strong businesses use downturns as opportunity rather than threat. Weak businesses see adversity as something to survive. Strong businesses see it as a filter. Competitors exit, talent becomes available, and assets are discounted. Strong leaders position their companies to exploit these conditions, gaining long-term advantage while weaker players collapse. Markets are not obstacles, they are proving grounds. Survival and growth are determined not by luck, but by preparation, discipline, and the ability to act decisively when conditions are unfavorable. In summary, weak businesses fail under pressure because their structures, leadership, culture, and systems are optimized for comfort, not adversity. Strong businesses survive and often thrive because they are designed for resilience. They combine disciplined leadership, adaptability, cash awareness, strong culture, and decisive action to not just endure challenges, but turn them into opportunities. Down markets act as a filter, exposing the weak and rewarding the prepared, proving that strength under pressure is the ultimate determinant of business survival and success.